Good morning. Eid Mubarak. Welcome. Thank you for joining today. It is going to be a very interesting journey, and I'm really glad to be able to share some exciting research that we've done at Sygnia. It all comes back to returns and risk. Who wants high returns and no risk? I certainly do. Most of my clients do. It is certainly the holy grail. How do we get above cash returns without taking on extra risk? No one wants to lose money. Everyone wants to make money. I've spent my career, 24 years, running a number of funds, different portfolios. I started off managing a smooth bonus guaranteed fund. Certainly that seemed to be the way to protect money and still get decent returns. I then moved on to hedge funds, which was quite exciting at times, less exciting at other times. Then onto structured products, where we use options and derivatives to try and protect downside, but still give you, above cash returns. And then from there onto a myriad of risk-controlled, volatility-controlled, risk parity, minimum variance, just all sorts of portfolios that try to control the downside using different volatility terms. Unfortunately, at the end of the day, when it comes down to it, there is no free lunch. And if you want high returns, you have to invest in risky assets. And if you can't afford the risk, well, then you pay someone for a guarantee. Or if you don't want the risk, you invest in low risk assets, bonds and cash, and you get a lower return, but with more capital stability. So the risk return payoff is, unfortunately, we are all slaves to it. There are other ways of improving your overall retirement outcome. Not as popular, unfortunately, but once you've got the best possible return you can from your asset class, well, then there are other methods, such as saving more for retirement. No one wants to, but it is an option. Save earlier for retirement. One of the ones that is even less favorable is working later, retiring later. That's certainly not what we want to do. We all want to retire as early as possible, but sometimes it's the only option. So not only getting a good asset return, but changing the behavior of your expenses and your savings is equally as important to the overall story when it comes to retiring. So when we talk about low risk, investing in low risk assets from an annuity perspective, that would be your non-profit annuities. And if we're talking about investing in high risk assets and paying someone for protection, that would be your with profit annuities. Of course, that leaves with living annuities, which I'm going to focus on today. And living annuities are quite flexible and give you some chances to change your behavior. And that was the focus of the research. Can we change our behavior? Is there scope for people who are retired, who are living off an annuity, to change the behavior, to allow them to invest in more risky asset classes, to take on some bond exposure or some equity exposure or some offshore exposure to get an overall better retirement outcome? And the answer is yes. So the good news is yes, you can actually get a better retirement outcome if you're prepared to change your behavior and to tighten your belts when markets are not favorable. So that's, if you just wanted the answer, then thank you for joining. You can go have some coffee. But if you want to know the details of how this works, then please join me for the rest of the slides. I will be staying on afterwards for questions. So if you have any questions, please put them onto the chat, and I will go through all the questions after the presentation. Okay, so let's start off with an introduction to the South African annuity market. The first category of annuities is non-profit. And right now, steep yield curves, it means the bonds are expensive and giving you very good returns, but also high yield curves because you're getting good interest rates on cash. So high returns on interest rates and high returns on bonds means that non-profit annuities are actually very competitive and very attractive relative to their history. And there are other benefits. The insurer takes on the investment risk. The insurer takes on the longevity risk. So you really are guaranteed that you get your payout. The simplest non-profit is your non-profit guaranteed level annuity. So on the chart on the right there, that's the blue line. That's 10,000 Rand a month, and you're guaranteed to get 10,000 Rand a month until you die. No money's left to your estate. The insurer takes on all the risk, but quite obviously in South Africa, where we have quite high inflation, 10,000 Rand might be enough for you to live off today, but in 30 years' time, 10,000 Rand is going to buy you a whole lot less. and is not sustainable for a retirement solution. So we have other options. You have guaranteed or fixed escalation annuities. So that is the red line on the chart on the right. You can go for a 5% escalation annuity. In return, you have to start off 30% lower. So instead of 10,000 Rand a month, you're getting 7,000 Rand a month. And that gives you some protection against inflation. Not complete, but some protection. You do then have inflation-linked guaranteed life annuities, and that's the yellow line. But you can see there from the chart, then you're starting off at a 50% lower level. So instead of 10,000 Rand, you're getting 5,000 Rand. They generally are relatively very expensive because it's almost impossible to hedge for inflation. So non-profit annuities, a very good starting point, but and despite being attractive right now with high bond yields and high cash yields, they don't really protect you against hyperinflation, or more importantly, in South Africa, they don't protect you against a weakening rand. It might be all very well if you're getting your 5% every year, but when the rand's depreciating a lot faster than that, in real terms and dollar terms, that they're not keeping up, despite the attractive bond yields right now. So there are other options. With property annuities, here you invest with the insurer. They invest in a mixture of asset classes, equities, bonds, local, offshore, and you receive returns or bonuses if the returns are good. So it's actually almost a kind of dynamic drawdown, because you're not guaranteed the same amount of money every year. Only if returns are good, your bonuses go up. The good news is that the bonuses can't ever go down. So you are protected on the downside, but in return, they take a 1% capital charge on average. And because of the starting mix, you end up with your starting monthly investment about 45% lower. So you're looking at about 6,000 Rand a month instead of 10,000 Rand a month. But at least you are protected against a weakening dollar, a weakening rand, and hyperinflation if it were to happen. You've got a much more balanced portfolio. The final option is a living annuity, and these are certainly proving to be very, very, very popular. Some of the reasons they're popular is that they're flexible. You can choose between a 2.5% and 17.5% annual drawdown, so that's up to you. You have the flexibility. You can invest in a range of asset classes, offshore completely, or equities, or bonds, or whatever you want to choose. So a lot of flexibility, and that's certainly shown in the ASISA stats. So for some reason, ASISA for the last 5 years didn't put out any stats on living annuities. And then in December 2023, a few months ago, they released the first stats on living annuities in 5 years. And they showed that the average, well, the total assets under management for living annuities is 626 billion Rand. I mean, that's definitely a decent sized industry, with the average drawdown of 6.7%. And that's very interesting. And I will get to that number later on as we go through your various options for drawdowns. 6.7% is actually quite high and quite hard to achieve as a sustainable static drawdown over the long term. But I suppose most importantly, when it comes to a living annuity, the annuitant is taking on the longevity risk and the investment risk. So on longevity risk, people might be comfortable with that. They want any money that's left behind to go to their estate, so they don't mind taking on that risk, although it does tie up with the investment risk. But if you don't invest correctly, well, you can end up running out of money. That's the key problem, and that's what we're going to be focusing on today, is how do you invest in a living annuity and try and protect against running out of money? And we call it time to ruin in terms of the modeling. How do you protect against time to ruin? How do you minimize the probability of that? And that's what we're going to be focusing on today. How do you invest in a decent asset mix, but protect yourself from running out of money without paying an insurer 1% capital charge to do that for you? So that's what we're going to be focusing on. So as I said, the main problem with the living annuity is the fact that you, as the investor, have to take on the asset liability mismatch when it comes to investing, and you've got to take on the investment risk and the longevity risk. So when you retire, you can work out what your expenses are. That's quite simple. And you know how much money you've got. So that's also quite simple. You divide the one by the other one, and you get how much money you need. And so that's 5% as just an average number. Now, every year you want to increase that 5% with inflation, because things go up with inflation. And that leads to a steady increase in your requirements over your retirement. So let's say inflation goes up 5%, then you're going to need whatever your current yield is, 5% going up with inflation every year. That turns that expense or that need that you require from your annuity into a real expense. It's got a 5% real yield, or you have to your payout has to grow with inflation every year, inflation plus 5%. It's a tough requirement, and there's no perfect match to that. There's no asset you can invest in that'll perfectly match that need. And also, inflation is not always going to be 5%. Sometimes it's 0, sometimes it's 10, but it should smooth out over time at that level. So, well, what do you invest in? Well, the simplest one would be equities. Equities at least have a real yield. The dividend yield that you earn from equities goes up with inflation over the long term. But there are problems. Firstly, there's a lot of volatility with equities. So you can end up having to eat into your capital at the wrong time and permanently eroding your base, which is a big problem. That's what you most want to avoid when it comes to all this modeling. You don't want to be in a position where markets have fallen 50% and you've got to eat into your capital and use your capital to live. Because then when markets recover, you're going to have a permanent hole in your capital base. So that's what you want to avoid. So even though equities, the dividend yield grows grows in real terms, you have this risk. There's volatility risk, there's growth risk. Earnings sometimes fall, dividends are sometimes cut, and not only that, but dividends are only 3% on average compared to what you need at 5%. So you're starting off with something that's too small, and it can halve, and it can stop during recession. So you need to balance that. So what you do, you add in some bonds, you add in some cash. They've got higher yields, nearly 10% right now. That's fantastic. Plus, it's almost guaranteed that you'll get your 10% yield. Fantastic. But they're nominal. They don't grow with inflation. So you put that in to at least help with some short-term cash flows and provide some stability. But at the end of the day, you're stuck with the fact they don't grow. Now, when it comes to precise modeling, I mean, when we model our portfolios, and we've got a range of portfolios, we model 8 asset classes. But for our modeling here, we just did 3. We wanted a growth asset, which is equities. We wanted an income asset, which is bonds, and we wanted a capital protected asset, which is cash. So we used 3 asset classes in our modeling, just to simplify it and to see how things go. But when it comes to actual investing, you can be a lot more clever and you can be a lot more nuanced, but you can end up with the same problems. You have real assets, which have growth risk, and you have nominal assets, which are safer, but don't grow with inflation. So I said we modeled the returns. We started off, we modeled the asset side, and then we modeled the liability side, and we put it all together to work out how long the money will last, what's your time to earn. So let's focus on the asset side first. We modeled 2 broad scenarios, a high inflation scenario and a low inflation scenario. So right now, as you can expect, we're currently in a high inflation scenario. Inflation inflation came out yesterday in the US for CPI at 3.8%. It's certainly higher than we want. In South Africa, inflation is about 5.5%, certainly higher than we want. And the expectation is that inflation is going to stay high for at least the next year or 2, if not longer. Why? Well, because we're in an environment where deglobalization is taking place. We've got a focus on supply chain redundancy. We've got a focus on supply chain security. We've got a focus on energy security. We've got a focus on friendshoring, onshoring, all of which is resulting in manufacturing having to be duplicated to provide a lot more certainty when it comes to receiving whatever you need in your supply chain, but at a much higher cost. So that cost is pushed onto the consumer, and unfortunately is inflationary. The other inflationary aspect we have right now is decarbonization. So in the past, we've just taken advantage of the environment. We've done whatever we wanted to, and profits have been maximized. Fortunately, or unfortunately, but from an investment perspective, unfortunately, we now have to price in the impact that we're having on the environment. And that does come at a cost. Whether you're paying for carbon offsets, or whether you are cleaning your filters, filtering your exhausts from your chimneys, or whatever it may be, cleaning out your processes, making it more environmentally friendly, using solar, using renewable energy, it all comes at a cost. So whether it's deglobalization or decarbonization, those are inflationary. And so we have a high inflation scenario that we modeled. We also modeled a low inflation scenario, which I almost call disinflation. And that's what I think we will actually come back to within 2 years. between the great financial crisis of 2008 and just up to COVID in 2020, that 12-year period was very much disinflationary. We saw quantitative easing for the first time in the Western world ever. And there were a lot of things that were happening that were disinflationary. Now, why were we in that disinflationary environment? Well, for a number of reasons. The first was aging populations. That is not going away. And if you think it is, just look at the ages of the presidents running for the US elections. Biden and Trump certainly show aging populations. That's just a joke. Actually, US has probably got one of the youngest developed market populations from an aging perspective. But still, aging populations are only getting worse, only getting older. And that means that fewer people are working, more people are retiring, and there's less opportunity for investment. There's less opportunity to grow. The second is debt. Debt to GDP continues to grow across the world, within companies, within governments, emerging markets, developed markets. That debt level continues to grow. And that just means that we're paying more and more money on interest payments, which leaves less and less money for research and development and growth. And so growth, again, slows down. And then finally, we've moved over the last century from being an agriculturally based economy to a manufacturing-based world to a services-based economy. And yes, different parts of the world are in different stages, but as we move down that spectrum, so each of them becomes less and less capital intensive. And services in particular, is very, very, very low when it comes to their capital requirements. And so once again, there's just less money required for investments. And all of that is just disinflation. You've got too much money chasing fewer and fewer opportunities. Either there are less people working, or the jobs that are doing are less capital intensive, and it results in less investment that's needed. Now, looking forward, AI is only going to make that worse. AI is going to replace jobs, it's going to replace people, it's going to make things more efficient, it's going to make things less capital intensive, and it's going to accelerate disinflation. And that's why I think within a few years, we are going to come back to this environment. And that's my forecast going forward. But we'd model both scenarios because who knows? You could have a high inflation environment. And certainly we are for the next few years. And it may go into a disinflation environment. But if not, you can pick the scenario that you want. When it comes to what we're talking about today, we've built a framework. And you can use any scenarios that you want to, any assumptions that you want to, but it's all about engaging in a conversation, having a tool and a framework that you can use for yourself or for your clients, and understanding what that means for your retirement and how you may have to change your behavior during your retirement, depending on what your assumptions are. Anyway, back to our process. So we needed an assets part of our model, our asset model. We wanted two versions, high inflation, low inflation. We then ran that through a Monte Carlo simulation, 60,000 simulations, which provided an efficient frontier, as you can see on that chart, the maximum return for lowest risk. And that produced 17 optimal portfolios for the low risk scenario, 17 optimal portfolios for high risk scenarios, 34 optimal portfolios with different levels of equities, bonds, and cash. But we knew that whatever blend of equities and bonds and cash we had was optimal, was giving us the best return for the lowest risk. So that was the asset side of the portfolio, of optimization. And then we moved on to the liability side, which is basically spending. And here we try to mimic what happens when a client goes to a financial advisor and they work together to define their needs, define the initial drawdown for a living annuity, and what's going to happen to that over time. So we worked with a portfolio that was reviewed and rebalanced annually. We assumed that the payout was increased with inflation every year. We worked on a 3%, 5%, 7%, and 9% drawdowns because that's your big range that you can use. Obviously, it can go up to 17.5%, but then the money's not going to last very long. This is the range that most people are using. But again, it's a framework. You can put in any number you want to. Assume the money was paid out monthly. Assumed it was tax-free because this is post-retirement where there are no taxes, which is fortunately one benefit for staying within the retirement framework within South Africa. No fees because our returns on our asset model were net of fees. And then a big one, an important one, is longevity risk. Obviously, within a living annuity, you are taking on the longevity risk. You don't know if you're going to die tomorrow or live to 110. You just don't know. Moreira, 2016, in his analysis of drawdowns within South Africa, said that the South African conditional median life expectancy, given you reach the age of 60, is 76. So what does that mean? Well, it means if you are born today, you are probably going to live to the age of 71 on average. But if you reach retirement, if you reach the age of 60, you've got through quite a few hurdles, then your median expectancy is 76 years, or 16 years for both sexes. But the important part here is few people are average. In fact, no one is average. No one wants to be average, and no one is average. And that's what's so important for the modeling. So there was no point in us modeling 16-year retirement period, because no one's going to have that exact experience. So we modeled 30 years, which may not be enough. We thought for the purposes of this, again, you can use longer in the framework, but we modeled 30 years, 360 months to see when would the money run out, based on those assumptions. So then we have our asset model, high inflation scenario, low inflation scenario. We have our liability model in terms of how much money you need, assuming that money statically grows with inflation every year, and you don't change that. So every year you're just getting more and more money paid out with inflation, so you can comfortably meet your living expenses. And then we brought them together. We ran over 200,000 simulations, combining different market scenarios with your needs in terms of retirement, and worked out the time to ruin, the sequencing risk, and how long will the money last on average, and worst case scenario. So looking at the results of the static method, the chart here shows three different tables. So the table on the left in purple is our high inflation scenario, and that shows your 17 optimal portfolios. Right at the top, 100% cash, it's your lowest risk. At the bottom, we've got 9% bonds, 91% equity. It's your highest risk optimal portfolio, according to our analysis. Then we've got a block in the middle, which shows your average time to ruin. On average, how long did that portfolio last for that drawdown? So you can see that it starts off with a 3% drawdown, then a 5% drawdown, then a 7% drawdown, and then 9%. So the numbers in the square are months, and say, well, for a 3% drawdown, for the first row, which is 100% cash, how long when your money would have lasted? Actually, it would have lasted a full 30 years, 361 months. That's where we cap the process. So if you're relying on a 3% drawdown, so if you need a 3% drawdown, you can actually afford to put your money in cash based on these assumptions. And then you've got no risk, and your money will last 30 years. May not last much longer than 30 years, and there won't be much left to pass on to your estate, but you can do that. Now, as you move up from a 3% to 5% to 7% to 9%, you can see there this downward sloping arrow. The green area moves down. And that shows that on average, as you require more money, so instead of 30 Rand a month, you need 50 Rand a month, or 70 Rand a month, or 90 Rand a month, based on the same level of capital, so you need to invest in more risky assets. So you can see if we jump straight to the 9% drawdown, your best option is actually to put 22% into equities and 78% into bonds for this scenario. Then on average, your money will last longer. So what this is saying is that it makes complete sense as you require higher returns, so you invest in asset classes that are expected to give you higher returns. That's right. So if you need a higher drawdown, 9%, well then on average you'll actually do better if you put all your money into equities. This simply. Unfortunately, and this is what I spoke about earlier when it comes to longevity, no one is average. And you can't rely on this average number. It is meaningless, because if you're there and you've got the worst case outcome, you don't care what the average is. You're sitting at the worst case outcome. So that's what this block on the right does. It looks at worst case outcome. What is the shortest time to ruin? What is the shortest time that the money lasted that across all our simulations? What is the worst case scenario? Now, again, we modeled a normal distribution for our returns. You could say that something could be worse than, there are a lot of assumptions to be put in place, but based on our modeling, it was the worst outcome. And you can see there the upward sloping arrow. So what this is saying is that if you look at cash, on average, your cash in a 9% drawdown will last 152 months. But worst case scenario is 143 months. That's 9 months low. There's not a big difference between average and worst case scenario when you're in 100% cash. That makes sense. Yes, cash sometimes is below inflation, sometimes mostly it's above inflation. It's not, it doesn't rotate much. It just depends on interest rates. There is some volatility, but not much. So your worst case is going to be quite close to your average. But when it comes to equities, the bottom row, on average, your equities here would last 173 months, but your worst case is 76 months. It's less than half. So that's just saying that, yes, while on average you want more equities, as you have a higher need, because of the volatility, you can't, because you could be in the worst case scenario. And in that worst case scenario, you end up having to eat into your capital. So the reason this is so low is that when the markets fall and you still have a high requirement, you actually have to eat into your capital at the worst time. And when markets recover, you don't recover as much because your capital has been permanently eroded. And that's why just adding more risk, high equities to your portfolio when you need higher risk doesn't work, because you can't afford that volatility. So what do? Well, you probably go with proper annuity. So fine, I need higher returns than just bonds. I need higher returns than just a level annuity. So I'm going to, or a fixed escalation annuity. So I'm going to go with proper annuity. I don't mind paying the 1% capital charge because I need exposure to those high risk assets. And at least then, if returns are good, I'll get a bonus. Yes, I pay away 1% a year, but at least my bonuses can't be negative, and I am getting some upside. And it's a very good solution. There's nothing wrong with that solution, and it works. You're forced to do it because you're in this asset liability mismatch where you need the higher returns, but you can't accept the higher volatility. But the whole premise of this is that it assumes static drawdowns. It assumes that you're going to increase your need every year with inflation, and it assumes that you've got no flexibility to change that spend. And in reality, you can tighten your belt a little bit. You don't want to, and the amount that you can tighten your belt certainly will vary by person, but in reality you can. And with proper annuity is actually to some extent that, as I said, because there are times where you get a 0% bonus. It means your money is not going with inflation. So you're going into with profit scenario, you already are open to this dynamic drawdown to some extent. The question is now, can we make it better? Can we look at more options? Can we get a better return for not paying that 1% capital charge? Or can we get a better overall retirement because we're being a little bit more flexible than just a zero bonus? What can we do? What can you look at? Scott et al. 2009 was critical of withdrawing a static drawdown from a inherently volatile portfolio. It makes sense. If your markets are volatile, you need to be possibly you don't want to be, but you possibly need to be a bit more flexible. So we looked into two broad methods where we thought of how can we model this problem? How can we look at investing in higher risk assets to get a slightly better return, and then adjusting the spend or the drawdown that the client has each year, depending on the market or depending on circumstances, to make sure that there's no permanent erosion of capital. That was the whole thing. So you just want to avoid. It doesn't matter so much if your portfolio is doing really well, and it doesn't matter so much if your portfolio is actually doing badly, but you've got tons of money, because then you can afford to eat into a bit of capital. What matters, what's most important, is you don't want to have your minimum required amount of money, and you've got to start eating into that at the worst possible time when markets are down. So that's what we wanted to try and avoid. And effectively, what we're trying to do is we're trying to turn a living annuity into a self-insured with profit annuity. So instead of a life with profit annuity, it'll become a self-insured living annuity. That was our ultimate end goal. So we had two broad methods that we wanted to look at, but both of them required assumptions. You had to forecast the asset returns. You had to forecast your expenses. Now, that is open to all sorts of debate. We have used our assumptions for our high inflation scenario and our assumptions for our low inflation scenario. if I had to talk about those actual numbers and those assumptions, everyone would have a different opinion. You could debate it for days or weeks or years. No one can see the future. That is obvious. But you do need a set of assumptions to not only allow the dynamic asset allocation or dynamic drawdown, but to engage with your client. So having assumptions, while the assumptions themselves are certainly variable, having assumptions is important because you can then plot the chart on the right. This is a chart without any volatility. This just says, listen, based on your expenses and assuming those expenses increase with inflation, based on your current amount of money that you have, we put them into these asset classes with our expected return, well, then your money's going to last this long. So at least you've got a discussion, you've got a starting point saying, well, fine, you can have a 7% drawdown, but then your money's going to last 20 years and not 30 based on these assumptions. And yes, every year you can review and you can see how markets did relative to the assumptions, but you need those assumptions as a starting point. Okay, so given we have assumptions for our asset returns and we have assumptions for our expenses, what do we do? So the first method was, the first dynamic drawdown method was based on work by Barton and Siegel in 2015. And this effectively works backwards. So it says, okay, how much money, when is your money going to run out based on all your assumptions? Okay, now based on, we want the money to last until that date. So in this case, if you look on the chart here, it's green, where the green line ends is 2018. Okay, so it's in 1994. Based on how much money you need at 7% drawdown, and we've got this expected returns from these asset classes, your money should last until 2018, so it should last 26 years. Maybe you're happy with 26 years, and you say, okay, fine, we're going to stick with that 7% drawdown. Now, what this method does, this annual annuity adjustment method, is okay, given that that's when you want your money to last until, let's every year see how much money you've got, and then calculate what you can take out so that your money lasts until that year. So it's working backwards to make sure your money lasts until you need it to last. Now, that has got certainly a big benefit. Your money lasts until it needs to last, which is great. But there are some problems. The first is that the amount of money that you might end up paid the last few years could be 2 cents on the rand. And the second is this, it's a very inherently volatile process. So your money could be cut by half and then double. So there's no control over that. And we try to show that in the chart on the right. So this is just one of the 204,000 simulations that we ran. Your monthly income profile, the green escalating line, which becomes the orange escalating line, is your planned drawdown. So that's how much money you want over your 30-year period. The green line shows, well, it's the blue line you can't see. The blue line is the static. So assuming that you invested your money according to your assumed returns, and you increased your drawdown inflation every year, well, then your money would just run out in 2013. Okay, so it's not ideal. You certainly aren't average. And you've got one of the scenarios that is worse than average. And so instead of your money lasting until 2018, it's lasting until 2013. But at least for those 19 years, it increased with inflation and you were happy, but then you had no money. So does the annually corrected method work? Well, yes, it does. In 2007, it said, well, you're starting to run out of money. Let's only give you enough so that your money lasts until the final point. Okay, great. But you can see here the inherent volatility where it cuts and then it increases and then cuts and it increases. And when it comes to close on the last few years, you're getting less than half of the amount of money when this process took place. So not only is it volatile, but it's not really enough. So we thought this is interesting, and it certainly achieves what it wants to achieve. We don't think it answers the question that we want. We don't think that any client is going to be happy with this as a solution because it's just not feasible. So we decided to look into our second method. And here the whole concept was, well, markets are cyclical because they're based on economies, which are cyclical. Economies go through recession, growth, acceleration, depression, recession. Economies do this. And as a result, markets follow that, and they have ups and they have downs, whether it's bonds or equities or currencies, they all have this cyclical nature to it. So if you're working on an inherently volatile investment, and markets because of your volatile GDP. Well, let's create a method that uses that volatility. In fact, it tries to harness that volatility when it comes to your drawdowns. So what we did is we created a method that looks at how much money you have relative to the expected amount of money that you have in your investment. And then based on that, we have some triggers and some haircuts. So the trigger, we need two sets of assumptions. The first one is the trigger. So when do you actually start to dynamically adjust your drawdown? And then the haircut, how much do you dynamically adjust your drawdown? And we modeled three, but I mean, it's completely up to you or a client in terms of whether you just want the first option or whether you're prepared to take the third option. It's all about your risk appetite and how much you are prepared to change your spending behavior whilst in retirement. So the first trigger was quite simple. Your capital value falls below your estimated value. So that's, you've got your estimated value of your investment, your actual value falls below that. Well, that's a trigger. What are we going to do? Well, in that case, we're just going to have no inflation increases. So that's effectively a zero bonus and with property annuity. That's, people can probably accept that quite easily. You're getting as much money as you have. You kind of, if inflation is by stealth eroding your expenses, but in the short term, you can probably accept that relatively easily. But we said, well, let's try and be a bit more aggressive just for flexibility. Let's see what it does. So we had a second method was if the capital, so the amount of money you have falls 10% below the estimated need, well, then we hit the second trigger. Why 10%? Well, because markets are, as I said, inherently volatile. In fact, on average, if you look at the S&P 500 over the last 20 years, every 2 years, there's been a 10% or more, at least a 10% fall in the S&P 500. That's actually a lot if you think about it. Every 2 years, there's at least a 10% fall in equity markets. So we chose 10%. And then for the haircut that is associated with that, we said, well, let's inflation is about 5%. Your first haircut is no inflation. So that's kind of relative inflation is kind of -5. So let's do another 5%, another -5. So, you know, in an ideal scenario, you would have gone from 100 to 105. If you've got your inflation increase, no inflation increases, 100 stays at 100. Second trigger, 100 becomes 95 in terms of get 95% of your money is paid out. And then the third one is something that happens less frequently. You know, hopefully once the economic cycle or the economic cycles have become a lot more prevalent, but you enter a bear market. So a bear market, a recession is linked to about a 20% fall in equity markets. And so we said, okay, assuming that economies go into recession, which pushes markets into a bear market, which is a 20% fall or greater. Well, then in that worst case scenario, that mean that things are pretty bad then? I mean, you've got a recession, you've got job cuts, you've got all sorts of problems. Well, then let's be a bit more aggressive. So let's take another 5% haircut. So instead of 105, we went to 100 for the first haircut. Then we went to 95, now we're at 90. So you have an overall cumulative 10% haircut to what you were earning from your retirement. Now, maybe 10% cut is too much for some people to absorb, and then that option is obviously not one that you would be willing to entertain, and that's fine. But we wanted to see for those people who either have to or can, what it means for their retirement, what it means for their asset allocation. Okay, so we have the model. Now, try and put that into pictures. This is just one of our 204,000 runs. The orange line, so this is your capital, the amount of money that you have for retirement. So it assumes that you retire in 1994 and you have R1 million in your retirement nest egg. Now that orange line shows how that will grow with what's your estimated, this is your estimated, how it should grow with estimated returns and estimated drawdowns, and then eventually comes down. Again, this one runs out in 2018. This is the same scenario we looked at earlier. The purple line shows your actual investment. So what you're going to see there, the first 10 years in this scenario, this is not, I mean, 1994 was just a date, but it's got nothing to do with markets in 1994 because this is based on our 60,000 asset models, Monte Carlo simulation. But in this simulation, you get really amazing returns. Your investment went from R1 million to 1.8 million rand in the first decade. Very exciting. But then a few years later, there was a big pullback and the first trigger was hit. So as we crossed this orange line, suddenly in that year, you wouldn't get an inflation increase. And then later on, You can see that line diverges behind the purple line. And then a little bit later on, you can see there we hit our first haircut of a 10% below the orange line. And then much later on, 20% below the orange line. So that's your 20% market, which is a market move, which is a 10% haircut. So 10% haircut at 80% and 5% haircut at 90%. It's all a bit jumbly here. So let's see what does that mean for your income? Okay, so we have our planned drawdown, amount of money we need. This is the escalating line. That's your ideal scenario. If for 30 years your money can be paid out with inflation increases every year. So what happens? Well, we've seen this before. Your blue line, your static, runs out in 2015 here because you're not making any adjustments, so it runs out first. The green line, which is the same as your annually corrected method, which we spoke about before, it's less volatile on this one. But it quickly runs into a level that you're not really receiving enough money to live off anyway. So it's a bit pointless, but it lasts as long as it was expected to last. So that works. And then we have the three other methods. So you can see with the first haircuts that they didn't, there was only one divergence. And later on, you can see the yellow, blue, and purple line. We diverge into three different methods. Your no inflation increase, your 5% haircut, and your 10% haircut. And as you can imagine, your 10% haircut, the purple line, lasts the longest, then your 5%, and then your no inflation increase. But they all went up with inflation. They all then gave a level amount of payout when they hit those thresholds. So it was a comfortable scenario from an investor in terms of, there's no volatility, and it does reduce your spending to the amount you can, and it lasts as long as it can. So this is just one example. Obviously, there were 200,000 overall simulations that we ran, but this is just to give you a picture of how the dynamic drawdown impacted your life if you are in one of those scenarios that was the worst off scenario or below average. This is one of the below average scenarios because none of us are average. Sometimes it's a good thing, sometimes not being average is a bad thing, but that's the portfolio. So what does that mean from an overall perspective? So now that we looked at one example, let's look at the average for all of our scenarios, all of our runs. What does it mean? And I've got 4 slides, one at 3% drawdown, one at 5% drawdown, one at 7% drawdown. So looking at the 3% drawdown first. So this is our high inflation scenario in purple, the top there, the top 3 graphics tables, and the low inflation scenario at the bottom at blue, and then the numbers to the left and the right. So everything here is 3% drawdown. The left-hand column you would have seen before. That's your average amount of months the money lasts on average in the first table. And then the table on the right is the shortest amount of time, worst case scenario that your money lasted, both in low inflation and high inflation. And then we've added in 3 new columns that you wouldn't have seen before. The first is no inflation increase. That's your first haircut, first trigger, first haircut. Second is your second trigger and a 5% haircut. And the third is a 10% haircut, assuming the third trigger was reached. And as I said, you can choose. You can either choose a static drawdown or only maximum no inflation increases, or you can choose to accept up to a 5% haircut or 10% haircut. Those options up to you. But I'm going to focus on the 10% haircut just to see what this actually allows if you are able to effectively have a negative 10% bonus. Now, the 3% scenario is actually not that relevant. I put it in just to say that if you only need 3% drawdown, well, you're very lucky. You can actually, as I said before, you can actually put all of your money in cash, and then your money will last the full 30 years, even on a worst case scenario. But what the dynamic drawdown does allow, if you're prepared to take on a bit more risk, and this is completely up to the investor's risk appetite, but if you're prepared to take on a bit more risk, you can actually make your worst case scenario in terms of how long the money lasts. It can maintain it 30 years, but if you're prepared to take on more risk and get a better overall return, then you can achieve that without any more additional investment risk. So this basically just says, if you're prepared, if you want more money left to your estate, well then, and you're prepared to cut your expenses by 10%, well then you can have a much better pool of money after 30 years without taking on any more risk. So it's not really needed, but it does allow the client to take on more risk if they want to. And generally, people do actually, when you've got this much flexibility, you do take on a lot more risk, and you can afford it. But it is important to look at the worst case scenarios, and you can, if you put your money, 3% drawdown into 90, let's use the bottom table, you put it into 100% equity. Yes, on average, you'll get your last 30 years or 351 months. But without dynamic drawdown, on a static drawdown, if you put it into that much risk, it'll actually only last 200 months. So there's quite a big impact. And you can then stretch that to 300 months with your dynamic drawdown. So it is important to show the impact of risk, and that dynamic drawdowns for this method do allow you to take on more risk. But if any of us are in the lucky position of only needing 3% drawdown, well, then you don't really need a financial advisor. You don't really need this fancy tool. You clearly don't actually need that much money to be paid out each year. You're in a lucky position. Let's look at 5%. 5% is far more closer to what people on average need. So Maria in 2016 showed that 5% withdrawal date is sustainable only over the short term, and he defines short term as 15 years or less. And 15 years is definitely, well, it's fine if you're an average person and your average life expectancy is 16 years from age 60, but for everybody else, it's not fine. So let's look at what dynamic drawdown allows. Well, firstly, if you look at the right-hand arrow here, your 5%, your static drawdown doesn't allow, even on average, doesn't allow money to last 30 years, but dynamic drawdown does extend it to 30 years. In fact, your worst case scenario in the 5% drawdown can be extended by up to 9 years. So you can see here, your static drawdown, if you put everything into your second option, 260 months, you can extend that to 360 months to your full 30 years if you take on, if you're prepared to dynamically adjust your drawdown, prepared in the worst case scenario to cut your income by 10% in those periods. That will allow you to take on more bonds and more equities, and you get a much better scenario. And on average, if you compare the high inflation and the low inflation and you average them together, the dynamic drawdown allows you to increase your equity exposure by about 30%, which means your money will last from a worst case scenario by up to 9 years longer. I mean, that's a huge, huge impact. And this is the most exciting result that we had, was at the 5% level, where if you're prepared to adjust your behavior, whether it's saving more while you're saving for retirement, or retiring later, or once you've hit retirement now, what options do you have if you are struggling to get your money to last the full 30 years or longer? Well, if you're prepared to take to cut your income by 10%, you can invest in 30% more equity on these numbers, and your money will last 9 years longer on a worst case basis. I mean, that's an extra 9 years is a phenomenal increase, and we were very, very, very excited about these results. Very, very, very powerful. Again, not something we want to do, but for people who are in a position where they need their money to last, you can actually get an extra 9 years out of your savings by dynamically adjusting your spending habits. The other important one is the 7% drawdown. Why? Well, because the CISA average is 6.7% drawdown. So that's for South Africa as a whole, people are drawing down 6.7%. So 7% is close to that, so we'll focus on that. Now, Van Appel in 2021 said that withdrawal rates in excess of 5% are not sustainable over 30 years. We completely agree with that. 7% is not sustainable. Unfortunately, it barely reaches 20 years on a worst case scenario, but it does. It's in fact on a static drawdown, it only lasts 15 years on a worst case scenario. So you can barely get 15 years out of a 7% drawdown on worst case basis. Dynamic drawdowns again does help. So on a dynamic drawdown basis, if you go all the way to the right hand side, this downward arrow, if you prepared to adjust your income by up to 10%, you can extend the worst case basis from 15 years up to nearly 20 years. So it's just over a 4-year improvement by taking on more equity. Now, the interesting thing here is, and why I have these downward arrows, is you can see the green block for this 7% analysis is lower than the green block for the 5%. And what that's saying is that because you've got a higher required return, a higher drawdown of 7 versus 5, you need more equity. You need more risky assets. And that's why, on average, you actually do better with further down the risk spectrum. Unfortunately, because of the higher withdrawal rate, you can't afford that higher level, because that's when you start to eat into your capital. So even though the first, your average is saying put more into risky assets, your overall solution is actually less risky. You can only add about 20% more equity to this scenario than the previous one, because you've got this bigger mismatch and there's a bigger chance that you're going to eat into your capital at the worst time. So unfortunately, again, the asset liability mismatch takes impact. There's still a big benefit from using dynamic drawdowns at the 7% level, but it's just less than at the 5% level because of your greater need. Okay, so that is it. So looking in conclusion, living annuities have an important part to play in South Africa. Given high inflation, given the probability of a weakening rand, either a hyperinflation scenario or a weakening rand scenario where the rand weakens far faster than inflation and you end up with less money in dollar terms than you would otherwise have, because the rand is not weakening at the inflation differentials. It's weakening far faster than different inflation differentials. And then also the high cost of a fixed escalating annuity or inflation-linked annuity or with profit annuities. So given those risks in South Africa, with living annuities have an important part to play. Dynamic drawdown annuity method doesn't really add any value, but the dynamic drawdown using estimated capital allows investments into a riskier asset mix, more equities, more bonds, to give you a better overall return in your portfolio and a better worst case scenario. And that's what's key. None of us are average. And on our worst case scenario, even if you take on more risk, if you're prepared to adjust your spending habits, you can get a better payoff from a worst case scenario. So this basically shows that we can actually create a low cost, self-insuring with profit annuity alternative. That was our overall aims, and we have achieved that. But and this is the most important thing of today is this is just a tool. The tool that clients can use with financial advisors to help them with the asset liability mismatch problem of a living annuity. So the living annuity, the client takes on the longevity risk, the client takes on the investment risk. It's both of which are very, very big risks to control. There's a lot of modeling needs to take place. So what we have here is not an answer. We have a tool that helps with the discussion with the financial advisor to work out what you should invest in, how long your money will last on average, and then if you are in that scenario where you do need to start taking on more risk than is comfortable, how, if you're prepared to adjust your drawdown dynamically, how much longer that will allow your worst case scenario to be. So it is a tool. The tool is there to create dialogue, to create communication, and to allow the advisors and clients to work together to get a better overall solution. And that's what we're most excited about, is the success of the overall process. Okay, that is a wrap. I do see there are a few questions. So let me delve into these questions quickly. Anonymous, that is a good question. Does Sygnia take on living annuities? Can you transfer living annuities? I'm sure we can. I can't see any issue with that. I transferred my retirement annuity to Sygnia, so I definitely know that was a very easy process. I mean, Sygnia was amazing in terms of filling out all the paperwork and doing that when I joined a while ago. Living annuities, I presume, can be transferred, but actually, don't know. PJ says, can I ask for a copy of the presentation? PJ, the presentation will be available on our YouTube site. So you are welcome to review that or watch that anytime you want to. Hitesh says, I've got some retiring. I have the option of taking 1/3 in cash or putting it all into annuity. Which options yields better growth? It really depends on what you're going to be doing with that 1/3 cash and what you're going to be doing with the 2/3 cash. And there are various options. Obviously, taxes is an important consideration, but it very much depends on what you're going to be doing. paying down debt is quite useful in terms of debt is your highest guaranteed return, but it's always good to pay down debt, but it depends very much on where you're going to be putting either of those pots. James, the presentation, the YouTube will be made available. James, living annuities can invest up to 100% offshore. So that is quite an important benefit of living annuities, is that there's no limit on what you can do with asset classes. So you can put 100% of that money offshore to get fully 100% offshore exposure. Anton, I hope I've answered your question. 1994 was just when we started our modeling, but it was a meaningless date. Had nothing to do with actual returns. Claude asks, Kyle, does Sygnia allow pensions to temporarily suspend their monthly drawdown in negative markets? That's a great question, Claude. I know on an annual basis you can adjust your living annuity methods. Whether you can temporarily suspend it, I'm actually not too sure on that one. We'll get back to you on that. Yes, Mr. Naka has a negative view on risks in South Africa. That is definitely true. Good point. We need to start saving earlier. Agreed. Alan asked about the hybrid. So Alan, we do have the Sygnia for Life, which is an amazing product. And Sygnia for Life marries a level guaranteed annuity with profit annuity, and that transitions over time as your needs change in a life staging model. Very, very, very clever product, and definitely worth looking into. So that is it's a very nice current solution that you should look into. That Sygnia for Life. Anonymous, yes. Modeling monthly cash versus annual cash withdrawals actually has a very material impact on predicted income. So it's quite interesting to see that. Monthly in arrears, monthly in advance compared to annual in arrear, annual advance had a big impact on the modeling. Again, yes, it is, Mr. Naka, it's a good point that not everybody can afford to have their the amount of money they're spending each year not increase inflation. It's certainly not ideal. So this modeling process wasn't the ideal solution. It's just saying for those, ideally we all have so much money that we can go live on an island. But there are occasions where you do need to save earlier, work later, or take on more risk so that you can retire comfortably. Chris says, in case of very high inflation, when governments are printing huge amount of money, what's the best asset class to preserve capital? I think that is a great question. And it all depends on demand and supply, really. There's so much that drives that. You can have, QE was a perfect example where money was being printed in huge amounts. But because there was no demand, QE ended up being disinflation, even though everyone thought it would be inflationary. But more recently, we've had very strong fiscal stimulus, and that's turned out to be more inflationary than we thought. But in general, most inflation that we've seen recently has been supply-driven due to supply disruptions or COVID impacts of people spending too much money on goods versus services, and then too much money on services relative to goods. So it all depends on what's driving inflation, whether it's good inflation or bad inflation. Good inflation, you want to be invested in equities. Bad inflation, you want to be invested in real assets like inflation bonds or gold or alternatives like Bitcoin. Thanks, Alan. Yes, Adrian, it is a pity that we do have the 40% cap on our living annuities. We really do want to change that, but that's purely based on the flows that we have and underlying market movements. So, as the rand gets weaker, so we get pushed closer and closer to our 45% cap, just because the offshore assets are growing faster than SA assets. So it's really on just like every year, SARS should ideally adjust the tax thresholds by inflation, so we don't have inflation by stealth. they should be adjusting at 45% by the difference in offshore returns compared to local returns, because otherwise you're forced to actually, in real terms, put more and more and more in South Africa. And that's what we're facing, that every year we get squeezed tighter and tighter because offshore just grows faster, and you get hit by that cap. And again, Magda in person is lobbying for this capital to be raised or at least adjusted with those returns. She's put out a fantastic paper to the SARB to try and lobby for those high offshore allocations, but no, we are where we are for the moment. My word, Ellie, you have a very, very long question. So in the interest of time, I'm not going to be able to get through all of it, but I'll read it and get back to you afterwards. Neil, there was no modeling of longevity or health conditions in the process, which is assumed a flat 30 years. Karen says, does the limitation of one change the drawdown rate per annum worsen the outcome significantly, since possible you possibly cannot adjust the time the capital drops? I see what you're saying. So what we modeled was a once per year impact, and it still worked. And what you're saying is, if you review it more frequently, will the model work even better? And yes, you're spot on. So if you were to review your drawdown every 6 months, then that can be done. The reason it works relatively well is that your asset basket does actually give a decent yield. So probably half of the year you can actually live off the yield from your equities, bonds, and cash. And it's only towards the end of the year you actually have to start to sell capital to pay out, or even in the next year. So it doesn't have a huge impact doing annually versus 6 months, but there is a little bit of an impact depending on which asset classes you're in. So good question. Paul asked the same question, the once a year. So it works because your yield, bonds give you a 10% yield in every year. So the cash that you're earning on average is about 5%, depending on your asset class. So if your drawdown is 5%, you can actually live off that yield for 1 year. Unfortunately, as you go into next year, then suddenly you've spent all that money, and now you suddenly need capital. But if you rebalance once a year, your cash mostly lasts. If you have a much more aggressive asset allocation, well, then maybe every 6 months is better to model it. And it's certainly something we can adjust. We can do that, and we can look at adjusting the model every 6 months. At Dion, there was no offshore or local splits. We just had one equity return, one bond return, and one cash return. George, if your living annuity is charging 4% per annum as advisory fees, it all depends on what services they are offering, but it is best to try and reduce your fees. And we keep quoting the paper from National Treasury in 2012, where if you can reduce your fees by 2%, you get a 40% higher, 60% higher retirement savings. So fees are very, very important. Yeah. If you want, please email Sygnia at admin.co.za, and we can definitely give you a quote on what our fees would be. Aaron answered the question. Thank you, Aaron. Living annuities can be transferred, and Aaron has done it many times to Sygnia. So that's fantastic. Thank you, Aaron Ratzenberg. Krista says, with Reg 28 compliant, Sygnia fund has good international stock exposure and has potential high returns, even if volatile, ideal for living annuity with low drawdown. So, Krista, that all depends on your needs. So, what we haven't modeled here is, and there are, and we can definitely help you with that, is how you translate the optimal portfolio. We got 17 optimal portfolios. Which of those closely matches which Sygnia fund? And we can certainly help you with that. But again, this is just a tool. So the actual answer that I've shown you, please don't rush out and invest in optimal portfolio 13 with 42% equity, because this is all very much dependent on the assumptions that we used, and everyone's got different assumptions and different profiles. So this is just a tool that must be properly populated with the proper assumptions for your needs. Andre says best withdrawal cycles once a year or every month. Andre, depends again on what asset classes you're invested in and how much cash they're producing. We assumed cash was paid monthly and only rebalanced annually. Johan, as I said, the Sygnia cap at 40% living annuities is not because of our balance sheet. It's got nothing to do with Sygnia. It's got to do with our client mix. And it's got to do with the limits that the SARB imposes on us, that 45% limit. And because offshore is growing faster, we have to keep changing that limit down to 40, so it doesn't reach 45, because offshore keeps growing to that 45. So if we allowed you to invest in 45 in a month's time, we'd be in breach. So we've got it at 40 so that it can grow to 45 with market returns. Dominic, I think I've answered your question on we can make it more flexible as opposed to just an annual rebalance, which would help very well. Des says, please give a review on your Rand dollar forecast. Des, so I have, there's some regular viewers here today and there's some new viewers. I put out a markets and economics webinar every month, normally around the first Tuesday every month. And I'll happily answer that question there. Please join. You should get the invite, goes out every month. If you don't get it emailed, it's on LinkedIn. Yes, anonymous. LA living annuities are paid out after tax, but they grow. Your investment returns are tax-free. So what I meant is we model tax-free returns in that growth. Yes, I completely agree that personal inflation is different to actual inflation. It is one of the reasons why with property annuity or living annuities is a good solution, because the 5% inflation that SARS or that is put out by Treasury, I think is much higher in reality for many people. Louise, I would recommend a financial advisor. Chris, Sygnia doesn't currently have any dollar-based endowments. It's something that we want to launch, but at the moment, even though we do have products that invest offshore, they are rands. We take your rands and we invest it offshore. We don't actually have any products that take dollars. It's something that we will be putting out. George, have a look at the For Life presentation. I think it would answer your question quite well. Pleasure. Yeah, Andre, I couldn't answer your question in Canada. We'd have to look at the model to see what that would look like. Sorry, we're a bit tight on time here. I'll try and answer some of these on emails, but a lot of them are asking complex questions that require inputs into the model. And I must stress, I'm not going to answer those, because the model is a tool, and it has to be used properly with the correct assumptions based on your expenses, the correct assumptions based on what you think inflation is going to do, your personal inflation, correct assumptions for asset classes. So the point of today's presentation was to say that if you are prepared to adjust your income during retirement dynamically, or then you can actually afford to invest in a higher risk asset classes and have a better overall solution. But I'm not providing any answers today. There's definitely no one size fits all answers when it comes to living annuity. Every person has a different risk tolerance, a different expense need, a different starting point, a different personal version of inflation. So I can't answer the questions which are coming through, and I really appreciate that you want answers, but there's just no one answer to fit any one solution. No, and there's no perfect mix. Trevin says he's just moved his pension preservation fund to Sygnia. He was being charged 4.2% fees. Now his fees are below 1%. That's Trevin. Well done. That is phenomenal. It does make a massive difference. So that is great. Okay. That's unfortunately, I'm out of time. Thank you so much, everybody, for joining. Thank you for the great questions. when it comes to any of these questions, I am available at the monthly webinar, which has a longer time period allocated to it, and I can give you more specific answers on our outlook for inflation, on our outlook for offshore versus local, on our outlook for the currency. But when it comes to this tool, my best advice is talk to an advisor, or if you are an advisor that uses Sygnia products, talk to your Sygnia representative, and we'll work with you wherever possible. So that is it for me for today. Thank you very much for joining. I hope you have a fantastic day, and I really appreciate your time. All the best.